Hey everyone, hopefully having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions, generally related to three different topics: wealth building, commodities, and/or financial topics. Let's dive in, take a look, see what's going on today. If you want to follow me at Finance, and if you want to join our community, finding-value.com, where I dive deeper into all of these topics and subjects, looking for investment opportunities and sharing them with everyone in the community. Special is the coupon code, and it's 50% off the first month only on a monthly membership, and a larger discount on the yearly membership. Special is that coupon code. All right, going into Brian, he says, money isn't the goal, freedom is. Money is just a tool to help you achieve the goal. Never lose sight of that. Well, I don't know if the goal is freedom. Uh, I would say it's gaining free time in a system that may not be completely free. So you're not necessarily going against the system, but yeah, it's freedom from a 9 to 5 job that I think most people are using that in. So money is a tool for freedom from a 9 to 5 job, if that's what it is, or it is the ability to live a life that maybe better suits you without money constraints. How about that? Peter says Walmart. So it says Walmart believes. So I believe sources about 70% of their goods from China, and the CFO told CNBC that tariffs are still too high at 30%, and were wired for everyday low prices. But the magnitude of these increases is more than any retailer can absorb. It's more than a supplier can absorb. And so I'm concerned that the consumer is going to start seeing higher prices. You'll begin to see that, likely towards the tail end of this month, and then certainly much more in June. Tail end of this month, much more in June, is what's coming for these high tariffs. Now, I don't know, I've watched a couple of clips, and what Trump and Bissett say is, oh yeah, the tariffs are paid by the the importing country, and that's not right. The tariffs are paid by American citizens buying the products from these certain locations. So what they're doing is they are putting extra taxes on certain goods and services that enter the United States from certain areas. The tax itself is paid by Americans if they choose to purchase, or if they select or purchase those items from China. But it gets kind of wonky because a lot of companies are not vertically integrated. So they order a lot of stuff from China, even though it might be made in the United States. Maybe 10, 20, 30, 40, 50% of the product is manufactured in China, and it's only maybe put together here as a final assembly. So I think a lot of products will be impacted around the world of anything that is made in China that gets directly shipped to the United States. Now, there could be things that they could do to get around this, and I'm not sure how they prevent that. For instance, one thing that maybe someone could do is open up a warehouse or something like that and buy Chinese products, ship it to the warehouse of a different country. They stamp a different label on that thing and then import it to the United States under a different label. I know there's a lot of probably ways around this, or you manufacture the bulk of it in China and ship it to another location, do final assembly at it, and put the made in whatever that country is that you're in, and then ship it to the United States and saying that's a final product. There's a whole bunch of things that they can do to get around this and still use China as a main manufacturer for whatever it is. That's my opinion there. We used to do that at my work. We we had these approved buyers or approved suppliers in our system. And if we wanted to buy something that wasn't from an approved supplier, we would have the unapproved supplier ship it to an approved supplier and then ship it into our um, company, and we could get it in the system that way. So there's all these workarounds that they do. Here's emerging equities ex China, and it says clean multi-decade breakout. Yeah, it looks fantastic. Emerging markets with a big breakout like that have a long way to go. I think looking at emerging markets and looking at some of these areas where they're down and they're cheap, great opportunity. And there's a whole bunch across the world, a whole bunch. Now, are they going to outperform select commodities when the dollar drops? Because mainly this is really the dollar dropping. And money starts to flow differently when the dollar is weaker against other currencies. So money goes where the currencies are strong. And generally, when you have a stronger currency, your economy is stronger than the other one that has a weaker. So the stronger dollar or stronger yen, Chinese yuan, whatever it is, money flows into whatever has strength. It flows out of the weaker currencies. Here's Urine Timmer from Fidelity. He says, if the secular tide is cresting, we will need to rethink the 60-40 paradigm that served us so well from the late 1990s until 2022. My sense is that we need to paint this canvas with broader strokes, emphasizing the alpha over the beta. Equities, yes, of course. Bonds, also, but maybe fewer than before, replaced by harder assets such as gold, commodities, Bitcoin, and cash. Harder assets, they consider Bitcoin a harder asset? I'm not sure about that, but this is the periodic table of investment returns. The ones at the top, given the year at the bottom, are the better returning areas. Over time, you'll get these cycles. Last cycle, if you look on the right hand side here from 2009 onward, you can see what outperformed. It's been Bitcoin. We've got large tech, I think that is, large growth all through here. So tech and growth, you can see the blue is towards the top. On the bottom here, I mean, you can see Bitcoin's up there and you can see Bitcoin's on the bottom for 14, 18, and 22. You can also see LT is down there too. So you get these huge outperforming and then you get these huge underperforming. I think that's large tech. During this time frame from 99 to 2011, you can see a completely different group that outperformed. The cycle is this period which changed in '09. Now this is a new period here. So this period here, we had emerging markets do well. You can see a bunch of emerging markets up at the top here. EM, 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 EM. They're all at the top there. You can also see gold showing up. Gold's here, gold's there. Tips, so Treasury inflation protected securities. And what happens usually at the beginning of these is gold starts to outperform. You can see gold work its way up to the top here. That happened in 2002, where looks like COM was up there, but gold was also up there. And look at where gold is right up at the right corner there. I think that we're going to start to see a shift from this, which was outperforming, to back to this over here. So you're going to see emerging markets start to outperform. You're going to see gold outperform, and you're going to see commodities. And that's the COM here. So you see commodity here, commodity here. Let me see if I can find any other ones where commodities were down here for 03, 04. And then they came back up in '05. You can see that's up towards the top. And it depends on what you invest. If you invest in some of the commodity equities, they provide a lot more leverage than even REITs. But REITs do really well. Emerging markets do well. Gold does well. You can see gold under here. And commodities do well in this general area. So that's that there. my opinions, you can see the emerging markets are breaking out. So that means we are shifting into a new paradigm. And that's the way that I have been uh, positioned. I positioned right here. I positioned in this circle there at the bottom, saying that this is a super cycle. Now everyone's saying, "Oh, you're wrong," and you're super. No, I'm right. Like it is right. This is wave one, wave two pullback, and then we are moving in wave three for emerging markets right now. It is going up, and we are going to go into a very big bull market, very similar to what this was back here. You get a big consolidation from 94 all the way to 2004. That's a 10-year period. This is even a bigger year. 2008, we broke out in a little over a 20-year move, and this is going to be a big, big move. And we can see that in the underperformance and outperformance of the table here. Many have no idea what 130 IQ actually means. Below is a graph of college majors by average IQ and gender ratio. Physics students are typically in this range, and so this is the female to male ratio. What means is males are over here, females are over here in terms of that ratio. It doesn't mean that females are necessarily not as smart, although they choose a lot of these over here. Um, what you see in these courses, this is all engineering and math and science. Mathematical science, physics and astronomy, philosophy, chemical engineering, economics, material engineering, physical sciences, chemistry, that's all over here. Um, when I went to school, it was all basically dudes. I was in engineering. And that's basically what you see in the school. It's almost all males, and they're trying to get more females into it, but I don't think that the IQ distribution supports supports that. So you're going to find certain individuals from certain ethnicities of certain gender types over here because they are more abundant in higher IQ, is what I'll say. Down here, we've got Luke Roman. Trump asks Apple to stop moving iPhone production to India. He says, I don't want you building in India. Trump says he asked Apple CEO Tim Cook to add more domestic production. So this is coming from an engineer who responded. He says, as an engineer for one of the largest EU multinationals with suppliers in Europe, China, and India, I can guarantee that we do not buy from China because it costs less, but because elsewhere they are not capable of producing according to our quality standards in the required times. It is the capability that is limiting things. And when I worked for a no-name company, I won't name them, we tried to move the production of something that was very difficult to build. The company moved it over to a different company overseas, and they couldn't build it. And it was very difficult with a lot of skill and know-how on how to build it. And you couldn't transfer it over. It's very technical, very tight tolerance pieces, and they're very large too. They're not small pieces. We're talking like the size of homes. So we had to bring it back to America because really the thing that limited us was the technical ability of creating the tools. That was really the big driver of moving it back. Josh Young says either oil prices are going higher or U.S. oil production won't grow that much. Harold Ham says he expects oil prices to be lower for longer. He sees U.S. oil output growing another 1.5 to 2 million barrels per day. Sees U.S. oil output peaking in the next couple of years. And where he is wrong, he's flat out wrong, in my opinion. He's wrong because oil prices are already too low, and you're not going to see growing of U.S. output. Output's already falling. So if we were to grow 1.5 to 2 million barrels, I don't think we can do that at the current price. The price has to go up for us to even think about growing that amount. I don't even think we can grow 1.5 to 2 million barrels a day, no matter what the price is. So there's a couple of things that we disagree on. So Harold Hamm, I don't know who this guy is, says he expects oil prices to be lower for longer. Now, lower for longer means that could be under $80. Who knows? I don't think that U.S. output growing 1.5 to 2 million barrels. I don't think that's going to happen no matter what the price is. So under a scenario of lower for longer, I think there's zero chance that we're going to grow another 1.5 to 2 million barrels a day. Zero. We're already seeing rig count fall. We're already seeing production fall. So he's already wrong. I mean, the fact that he's coming out and saying this, I would say, is kind of weird because production's already fallen an okay bit, and rigs continue to fall. So I don't see how production's going to go up 1.5 to 2 million barrels with the declining rig count. Doesn't make sense to me. Like it just doesn't make sense. Like when I read some of these things, I'm like, do they even look at the data? Do they even look? Do they even look at it? I mean, I'm just curious. I wonder if these guys even look at it. I don't know. Clint Simmons says, I do not see how Mr. Ham's proposed statement even makes sense. So the USA is going to increase production by 20% from here, and yet crude oil is going to remain lower for longer. Almost no chance of that happening given publicly available information, including publicly traded E&Ps already curtailing some capex, etc. It make sense. Well, at least someone else is looking at it and drawing the same conclusions that I am. Because I read it and I'm like, this is just straight garbage. They might be releasing this on purpose to try to jawbone the prices lower. There isn't a chance in HELL that we're going to go up 20% in production and have prices be where they're at today. There's no way. And if we lose production, I don't even know if Saudi has spare capacity in the quantities needed of the production that we're going to lose over the next couple of years. Like that's where my mind is at, which is like, I mean, this guy's in a different state when I think about what he's saying here. Like we're not even on the same page. We're not even reading the same book. We're not even on the same continent. So Josh Young says oil stocks might go lower, maybe, but what happens when they go higher and they're only 3% of the index funds everyone owns? And this is the oil and gas stocks have a lot of room to catch up to the broader market. No wonder they are so hated. Where most see challenges, I see opportunities. S&P 500 given back in 2014. Now 2014, that year in particular, was a year that they overproduced. We got into a production supply war of shale versus the Middle East. We are not anywhere near like 2014. We're like in the opposite. We're like 1970, where United States is about to peak in oil. In 1970, we had a bunch of spare capacity in the world. We don't have that right now. The world is America in 1970. In my view, where we don't have spare capacity, we're going to hit a peak at some point here over the next, say, year, 2 year, 3 year, and the world's going to say, "What the heck just happened?" Like, there's a possibility that 5 to 10 years from now, this world will not look anything like it does today, because energy prices will be so expensive, and yes, we'll have recessions and stuff like that in between because it'll get too expensive. But that's kind of what I think is coming. And it's okay if other people disagree, but that's kind of what I think could be an outcome, and most likely will be an outcome. This guy says, be the one on the right where you're reading through fundamentals, stuff like that. You're not reading charts, trying to day trade and do that stuff. That's what he means by that. Warren Buffett says, you don't have to be right about thousands and thousands and thousands of companies. You only have to be right about a couple. So Warren Buffett's success rate is very low. I mean, it's like 14 companies out of 300 or 400. And that's just percentage of being right. What he did and what he did right is he stuck money in those companies and he overweighted the right ones. And then he just rode them for a very long period of time. So you need to be right about a couple companies, but you need to be right and stick with them for a very long time. And that's exactly what Buffett did. Fund manager sentiment remains extremely bearish. So these are all these trade wars going on. And here we are in bearish sentiment territory. It says B of A global FMS investor sentiment improved slightly in May from a very bearish April level. What happens when the market realizes they should be selling bonds and maybe not buying them? I don't know. Interest rates will go up, and that's kind of what we're seeing. And then Dissent's going to have to come in here and buy everything up, I guess. Dissent and Powell, the J. Pow. Tapped mic clears throat. Nothing stops this train. How is this not an objectively disastrous development? And he's showing interest rates going up. And Lynn Alden just says nothing stops this train. It's the way it is. We need to continue to print money for the system to survive. Inflation's coming through the system and interest rates will go up. Nothing stops that. Nothing stops this train. Mike Howard says, we see a lot of opportunities because most of the world seems to be operating in some sort of energy poverty. And reduced poverty is driving demand for energy. So the richer you get, the more energy you consume. India and China are coming up. They're getting richer, and they are going to consume more and more energy. And that's where the problem lies. The problem is, do we have enough energy for everyone to live at a pretty high level of prosperity? And I don't know. It's going to get real tight here at some point for not energy demand, but for supply. Fed Chair Jerome Powell is warning that supply shocks from tariffs could force them to keep interest rates higher over the long term. Powell warns of more volatile inflation as latest data shows impact from tariffs. Man, these guys hate each other. I love it. Powell versus Trump. Trump's over here saying, oh, things are going down. They're not going down. And Powell's saying, no, wait, these things are going to go up in price, not down. I'm not sure what's going on between the two, but if nothing's gone down for me, nothing I purchased has gone down. The only thing that's gone down is the size of the products that I'm purchasing. There's a bunch of things that I have noticed that are way less in the things that I purchase, or they cost a lot more. Well, most of them cost more and there's less in. If you consider yourself a stock picker, at some point in your life, you must do the work others aren't willing to do and form extreme conviction in something you believe in. But it takes work. You must do the work. You must form the conviction. The peanut gallery and your emotions will be screaming at you to sell. Holding winners is extremely lonely. That's what I do. Just been holding on. And everybody tells me to sell. That is true. And they try to time the short term. They tell me that recession is coming in 2021, 22, 23, 24, 25, blah, 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 blah. The best thing you can do is get a real good price. Be very, jump on that good price, buy it, and just sit on it and wait. I don't really know of any other way to make large sums of money over periods of time. Trading, you can't do that because you don't deploy enough capital. You don't want to put 100% of something into one idea. You can get absolutely smoked very quickly if you do that. So you have to diversify across ideas. The problem is if you're trading, you don't have that many ideas. And you always have to be looking and looking and looking and trying to find good ideas. Now, if you're buying something that is just wicked cheap and you're coming into cycle, then you just ride it for the entire cycle. And that's basically, there's no other strategy that can beat that I know of for sizing up, quote, the big move and then riding the big move. Now, it takes patience. That's what it takes. It takes a lot of patience. From the silver chapter of the just released In Gold We Trust report, So this is from Peter Krauth. He says, we are here, and this is what other bull markets in silver have shown. So silver after gold breakout to all-time high. So we're coming across here in this purple area where we are, and this is where the potential target is. Looks like it's up around $100 or something like that in a very short period of time. That's August of 2025. Eric Yoon says, milkshake simps really think that the 10-year U.S. Treasury yield will top at 5%, if not for stealth outright QE. And this is Treasury bonds breaking its downtrend, moving on up. And I agree, guys. I think they're going to step in with QE and destroy the dollar. That's what I think. And then your commodities and emerging markets will go up because the dollar is going down against other currencies. Maybe they inflate everything. Maybe emerging market currencies inflate and the dollar inflates and they just inflate everything. Then gold will be a huge winner, but that's already been a winner. And that's kind of what everybody's doing. So interest rates, I think, will continue to go higher until a force is acted upon it, which is QE, that QE force. Breaking news, United Health is under criminal investigation by the Department of Justice for possible Medicare fraud. United Health is down another 7% in after hours, and this thing's just getting smoked. That's a large company. It's a big boy company, and that thing it's down over 50% from its highs. Sorry, guys, I had a yawn there. Down 50% from its highs. Warren Buffett provided his view on when the next crash will happen in the latest shareholder meeting. Here's what he had to say about predicting the next crash. He says, the long-term trend is up. Nobody knows exactly when it will happen. And I certainly don't know. Nobody knows what business is going to do tomorrow, next week, or next month. They spend all their time talking about it because it's easy to talk about, but it has no value. I've never found anybody I wanted to listen to on the subject. And on the other hand, I found the leafing through things like that big Japanese book that I can't read anymore. That's a treasure hunt. And every now and then you find something. And occasionally, very occasionally, but it'll happen again. I don't know when. It could happen maybe next week. It could be 5 years off, but it won't be 50 years off. We will be bombarded with offerings that we'll be glad that we have cash for. And it'd be a lot more fun if it would happen tomorrow, but it's very unlikely to happen tomorrow. Very, very unlikely to happen tomorrow. But it's not unlikely to happen in 5 years. And then the probabilities get higher as you go along. What are your thoughts? Well, what he's doing is he's got a bunch of cash and he's just waiting for a potential problem in the market where he can step in and buy a bunch of assets for a very cheap price. He's basically waiting for a large recession to deploy capital. That's all he's doing. He doesn't know when it will happen. He just knows that it will happen at some point, and when that does occur, all your financial metrics will be very good, and he'll deploy capital at an area that is incredibly cheap. So that's what he's trying to do. Basically, he's trying to time the market, but he's only timing it using valuations. You guys said I'm a perma bull on uranium, and you need to look at the charts. So I bought a book on technical analysis. Voila, I see a bull flag on SPUT with measured move to $50 a pound. Now what? Now what? What do you mean now what? Just buy it and hold on. We're in a bull market. We are in a bull market for uranium. Most people will say, oh, well, it's gone down and it's had a big pullback. I'm sorry, guys, we bottomed in 2016 or 18 or whatever it was, and then we've been going up ever since. So it's a bull market. Warren Buffett says, Charlie and I have always thought that our cost of capital is represented by what we can do with our second best idea. Basically, what he's saying is, You want to go into your big ideas. You want to go in heavy if you do the work that they do. And then you don't want to be piling into your second best ideas or third best or fourth best because that is your cost of capital. Freight futures AM updates. Dry bulk is up. Capesize up 2%. Panamax up 1%. And tankers are also up 1% for both VLCC and Suezmax. Rick Roll says, I've seen better than tenfold moves in silver bullion 3 times in my life, and none of them accompanied increases in industrial materials markets. So basically, they've all been just demand from precious metals owners and stuff, not from industrial users. A little bit different market that we have today versus back then. Wood Mackenzie sees challenges meeting gas power demand over the next 15 years. That's where my head's at. I think it's going to be difficult to meet the natural gas power demand over the next 15 years. This is 8 70-year-old supergiant fields produce 80% of Saudi's oil. Saudi, in spite of a massive exploration effort, hasn't found a giant field in 50 years. Think about that one. Oh, yeah, we've got all these fields. So a lot of people think that oil is going to go up and we're just going to find more oil. No, I don't think so. We've been finding less and less oil this past 30, 40 years. I mean, we haven't found crap since like 1980s. And we know where most of the oil is. It's just like, it's going to be really hard to get out. And money isn't going to be the driving factor. It's energy return on energy invested. That's the big one. Could we convert, I don't know, electrical power into liquid fuels, even though it's not super efficient? We could. If we had a real cheap source of energy, we could. Possible. Total U.S. oil inventory. Okay, I already went over that one last time. So we're going to end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. Special is the coupon code. We've got a Sunday question and answer session coming up at 5 p.m. Mountain Time. I'll see you guys there. Catch you next time. This is Finding Value.